Good morning, it's Jeffrey Christian, CPM Group. I'm actually recording this around 2 o'clock on Wednesday, the 5th of October. We'll release it on the 7th of October as our Friday. And I've been asked today to talk about the US dollar and to compare the current situation to that which occurred in 1985 when the Plaza Accord was reached among major central banks at the time. And in order to do that, let's first start talking about the current situation in the dollar. The dollar has been rising. It's actually been rising since 2011. It's up about 31% over that period of time. And really since the beginning of 2021, when the economic recovery from the recession of 2020 began, you've seen the dollar rise sharply once more than 10% in the last 18 months, 20 months. There are some central banks that have intervened recently, selling dollars, buying their own currencies in order to strengthen their currencies. And that's led to a discussion among some people, at least, of the Plaza Accord, which occurred in September of 1985, and whether or not there might be some sort of central bank agreement this time around where the central banks say, let's try to coordinate our foreign exchange market intervention in order to push the dollar down. It's not going to happen, and there are a variety of reasons. And basically, what we're seeing today is not what we saw in 1985. And I'll talk about that in a short period of time. I will add that there is a broader discussion of this in CPM Group's October Precious Metals Advisory, which should have come out October 6th, yesterday, by the time you're seeing this. We're working on it today, October 5th, as I'm talking to you. But this is a combination of, you can see on the right-hand side, the chart I just showed you enlarged, the trade-weighted dollars since 2010. And you can see the 31% increase. The chart on the left, which I'll show you in greater detail in a second, is the trade-weighted dollar since 1968. And the dollar was freed to float in 1971, August of 1971, when Richard Nixon floated the dollar and closed the gold window, the official gold window, and made gold no longer convertible to the dollar at $35 an ounce. You had seen devaluations in the dollar and other currencies prior to that, but you had a fixed exchange rate. The dollar was fixed to gold at $35 an ounce, and other currencies were fixed to the dollar at fixed rates. So you didn't have the currency changing every day. What you'd see is that there would be inconsistencies between the exchange rates, the fixed exchange rates, and the economic realities among different countries. And that would lead to financial stress, and then you'd have an official devaluation. So it wasn't that the exchange rates changed every day. You would have long periods of time when they were fixed, and then there'd be this official devaluation, revaluation, and ratcheting down, which was actually much more disruptive of economic activity than the day-to-day changes decided by the market since 1971. Anyway, here's that chart up close. Now, first thing you need to know is that from 1971 until 1980s, the early 1980s, we had what they called a dirty float. Currencies were floated. They were allowed to move up and down as market and economic circumstances mandated, but governments would come in and intervene. And from 1971 into, say, 1980, 81, 82, central banks squandered billions of dollars trying to keep their currencies strong or weak, depending on what their economic policies were at the time. And they would come in and they would buy their currencies to support them, or sell their currencies if they wanted a weaker currency. And it didn't really work too well. Also, a lot of the governments at that time, especially the internationally trading nations' governments, had most of their foreign exchange reserves in either dollars or gold. And there was a lot of gold in there. And if you wanted to use your foreign exchange monetary reserves that were in gold in order to intervene to support your currency, first you'd have to sell the gold in a relatively small illiquid market. And you'd sell the gold to get dollars, then you'd sell the dollars to buy your currency to support your currency. So it was a cumbersome and not particularly efficient way to do it, the dirty float. By the early 1980s, central banks realized that that was not really wise. Now, we had seen the dollar actually start to rise a little bit in the period 1978-1980. But then after 1980, during the period when Paul Volcker's Fed policies were breaking inflation, but we went into a double dip recession. First, we went into a short recession in 1980. We went into a bigger one in 81, 82. And from that period onward to 1985, the dollar rose, and it rose strongly. Now, I talked about the 31% increase since 2011. Back then, from 1980 into 1985, you had a 56% increase in the dollar. During that period of time, central banks and economists and other reasonable people realized that central bank foreign currency exchange interventions weren't effective in reversing the trends in the market. So if the dollar was rising and you wanted the dollar to fall, it really wasn't an effective way to sell dollars to try to change the direction of the dollar. Similarly, if other currencies were rising and you wanted them to fall, it didn't make sense to do it. So people realized, central banks, governments realized, if you really want to change the direction of a currency, look at the fiscal policies that drive the economies of those two countries, or however many countries are involved in the currency system that you're looking at. Change the fiscal policies, and that will change the currencies. And in terms of currency exchange intervention, central banks came to say, we cannot reverse trends, but we can accelerate trends that exist. So if we want a lower dollar, which is what some people were thinking 1983, 1985, we're not going to be able to turn the dollar around by selling dollars and buying other currencies. However, there will come a time when the dollar starts to fall, and we can accentuate that decline by selling the dollar. We can accelerate trends that exist in the real market. We can't really turn them around. And that worked. The dollar peaked in February of 1985. The Plaza Accord was concluded in September of 1985. So 7 months after the dollar had started to decline, central banks got together at the Plaza Hotel here in New York and said, let us start selling dollars to accelerate that decline, to depreciate the dollar so that it's not so strong against other currencies. That is the environment in which the Plaza Accord occurred and was agreed upon and operated. Completely different from where we are today. First off, you can't make an argument that the US government wants to see a weaker dollar, and you can't make an argument that other governments want to see a weaker dollar. You know, quite frankly, a stronger dollar right now is extremely beneficial for people in Germany and other European countries and Japan who export to the United States, because a stronger dollar makes their imports from those countries more affordable and increases their exports and increases their economic activity. Yeah, there's a joke among European central bankers because there are people who thought back in 2010, 2011, during the most recent international current sovereign debt crisis, that the German people must have been upset that they were in essence subsidizing the southern tier economies, Greece, Italy, Spain, Portugal, and to some extent Northern Ireland, that were in the euro and were benefiting from the fact that they had a stronger currency in the euro than they would have had in their domestic currencies, while the Germans were seeing a weaker currency in the euro than they would have seen in the Deutschmark. The reality is that most Germans were well enough informed and educated. They have a better education system than the United States has, apparently. They knew that their jobs, their well-being, the relative wealth that they were incurring were all benefiting from the fact that they had the euro to weaken their currency and improve their overall economic activity through exports. Subsidizing the southern tier economies was seen as a small cost for that economic benefit on the part of Germans. So back in 2010, 2011, when certain people in the United States kept saying, well, the Germans must really be upset that they have tied their currency with the southern tier of the Eurozone, they were wrong. The Germans were pretty much aware of the benefits that accrued to them personally, as well as a nation and a national economy, by virtue of the fact that they were in the euro and not in the Deutschmark. So the Plaza Accord occurred at a different time. And it occurred at a time when most of the major central banks saw value in a lower dollar after the dollar had risen 56% in the matter of 5 years. And it only occurred once the dollar had peaked and was 7 months into what you can see here was a multi-year decline. So it doesn't really apply to where we are today. What's all this mean for gold? That's a good question. The relationship over time since 1968 between the changes in the dollar's exchange rate and gold is a negative 34%. You've heard me talk about this over and over again. 66% of the time, you might even say 2/3 of the time, gold and the dollar are not moving in opposite directions. Sometimes they're moving upward or downward together. Sometimes there's just no correlation between them. One's moving up or down and the other one's not moving. The dollar and gold are the two risk-averse assets of choice for investors around the world. Sometimes when things are scary, as they were in 2020 and as they are now and as they will be in future years, sometimes people will say, I want to buy gold and the US dollar. I want to denominate my wealth in gold and the dollar to protect my, to try to preserve some of my buying power of my assets. Sometimes they say, I just want the dollar. I don't care about gold, which is what's happened over the last several months. Sometimes they say, I don't care about the dollar. I only care about gold, which is what happened in 2019, 2020. And sometimes they want both. So what it means for gold is actually relatively meaningless, because the reality is that you won't see a Plaza Accord type agreement. There's probably not a lot of consensus that the dollar should be lower. Obviously, some central banks would like it. Other central banks wouldn't like it. At 110 on a trade-weighted basis, the dollar is way off from where it was when the Plaza Accord was struck, 140, on its way down from 155 on a trade-weighted index basis. It's just not 1985. So we're looking at gold, and part of the attraction for gold for investors right now is its relative diversification of your currency, both as a denominator of your wealth and a numerator of your wealth. Part of it is an inflation hedge. Part of it is a portfolio diversifier. Part of it is a commodity. Part of it is a safe haven asset. It's all those different things combined. And gold still makes sense to investors, even in the face of a strong dollar. And in fact, as the dollar strengthens, gold gathers attractiveness to savvy value investors. That's all I have for now. Talk to you next week. take care of yourself and those around you, and try to take care of the world. It needs your attention.